January natural gas futures surged on Friday, punching cleanly above the 200-day moving average at $4.73 as a deep winter blast spread across large portions of the United States. The market reopened after Thanksgiving with a clear bullish tone, driven by the arrival of the season's first widespread Arctic push. Much of the central U.S. has now entered its coldest stretch so far this winter, and forecasts indicate that below normal temperatures will linger into the opening days of December. According to the National Weather Service, highs are expected to remain locked in the 20s and 30s across the Midwest, with the northern Rockies and Plains seeing temperatures plunge into the teens and low 20s through the weekend. A high-impact winter storm is also sweeping through the northern Plains and upper Midwest, delivering 6 to 12 inches of snow and locally higher totals. The Great Lakes region continues to endure intense lake effect bands, where accumulations of 1 to 2 feet are already being reported. These widespread winter conditions are lifting near-term heating demand projections and helping reinforce the current bullish tone in the futures market. However, the outlook is not without risks. While short-term weather is clearly supportive, longer-range models have started softening, showing less sustained cold as December progresses. Analysts warn that if extended forecasts continue to moderate, upside momentum could fade quickly. In the near term, LNG export strength and continued cold would be the key drivers needed to propel prices through additional resistance and maintain the bullish trajectory. Meanwhile, buoyed by the recent price strength, gas producers are ramping up activity, pushing the active rig count to 130 this week, the highest level since July 2023. For bullish traders, that's a clear caution flag, as rising rigs signal that supply growth could soon start leaning heavily against the rally. The near-term tone remains skewed to the upside as winter weather boosts heating demand, but the market's footing is far from secure. A prolonged cold pattern would likely give prices enough momentum to push toward the $5 mark, yet any shift toward milder forecasts could quickly sap that strength, especially with storage levels providing a substantial buffer. Traders should keep a close watch on how the models evolve. The rally's durability ultimately depends on them. From a technical perspective, the market heads into next week with a cautiously constructive tone, supported by winter weather and firm LNG demand, but still highly sensitive to shifts in the forecast models. In the base case, natural gas is likely to trade in a broad range between $4.50 and $5, with colder than normal conditions helping to hold the floor while ample storage prevents an unchecked rally. A more bullish outcome becomes possible if both major weather models lock onto a sustained cold pattern stretching across the Midwest and Northeast. In that scenario, heating demand would strengthen enough to drive a quick push toward the $5 to $5.50 area, especially if LNG feed gas volumes remain elevated. The downside risk emerges if the longer-range outlook turns noticeably warmer. Should forecasts shift toward moderation and production remain strong, prices could slip back into the $4.40 to $4.70 zone as the market reassesses winter demand expectations. The range of possibilities remains wide, but next week's price direction will depend primarily on how weather trends evolve and whether traders continue to buy into the cold narrative. Don't forget to drop a comment, hit that like button and support the channel if you'd like to help keep this channel going. See you in the next one.